There's a number that changed how I think about money. Not a net worth goal, not a savings rate, not some aspirational income target you pin to a vision board and forget about. It's a very specific number, unique to you, and once you see it, you can't unsee it. It's called the crossover point. And if you're in your mid 30s right now, feeling like you started too late or you're too far behind, this single concept might be the most important thing you learn all year. Let me show you what it is and why the math is better than you think. First, let me describe where you probably are right now because I want you to know I'm not guessing. You've got something in a 401k, maybe a Roth IRA too. Somewhere between $40,000 and $180,000 invested, probably sitting in a target date fund or an S&P 500 index fund you picked years ago during onboarding and haven't looked at since. You've got a mortgage, probably a car payment, maybe some student loan debt still hanging around. Your cash cushion exists, but it's thin enough to make you nervous. And every month feels like this treadmill where money comes in, money goes out, and the gap between those two numbers never seems to grow fast enough. Here's what nobody tells you. That gap is the only number that actually matters, not your income, not your expenses in isolation. The gap. And the crossover point is the moment when your investment income covers that gap permanently. That's it. That's the whole concept. When the money your money earns each month equals or exceeds what you spend each month, you've crossed over. Work becomes optional, not theoretical, not someday, mathematically optional. So let's build the math together because it's simpler than you'd expect. Take your monthly expenses, everything, mortgage, groceries, insurance, subscriptions, all of it. Let's say that number is $5,000 a month. That's $60,000 a year. Now here's the key question. How large does your investment portfolio need to be so that it generates $60,000 a year without you touching the principal? If we use the 4% rule, which comes from the Trinity study and basically says you can withdraw 4% of your portfolio annually with a very high probability of never running out of money over a 30-year retirement, you take your annual expenses and divide by 0.04. 60,000 divided by 0.04 equals $1.5 million. That's your crossover number. That's the portfolio size where work becomes a choice, not a requirement. Now, I know what just happened in your head. You heard $1.5 million and something inside you clenched. You're 36. Maybe you've got 80,000 invested. 1.5 million feels like a different universe. But stay with me because this is where it gets surprising. Let's say you're investing $700 a month right now. Maybe that's your 401k contribution plus a small Roth contribution. $700 a month is $8,400 a year. If your portfolio averages 7% annual returns after inflation, which is roughly what the S&P 500 has delivered historically over long periods, here's what happens. In 10 years, that 80,000 grows to about 320,000. In 20 years, it's past 700,000. In 25 years, you're crossing 1.2 million. And at around year 28 or 29, you're hitting that 1.5 million crossover point. That puts you at age 64 or 65, which honestly sounds like basic retirement planning. But here's the part that changes everything. Every single optimization you make accelerates that timeline dramatically. And I don't mean dramatic lifestyle changes, I mean targeted surgical moves. If you increase your monthly investment from $700 to $1,000, you shave roughly 3 years off. If your employer matches even 5% and you're not maxing that match, capturing it is an instant 100% return on that money. If you reduce your monthly expenses by just $300, not only do you invest more, but your crossover number itself drops because you need less annual income. That $60,000 a year drops to $56,400, and suddenly your target portfolio isn't 1.5 million anymore. It's 1.41 million. You move the finish line closer from both directions at once. This is why the crossover point is more powerful than any other financial metric. It responds to both sides of the equation simultaneously. Earn more and invest the difference, the timeline shrinks. Spend less and invest the difference, the timeline shrinks even faster because the target also gets smaller. Most financial advice treats income and expenses as separate conversations. The crossover point welds them together into one single visual you can track month by month. Here's what I want you to do tonight. Pull up a calculator or a spreadsheet and figure out three numbers. Number one, your actual monthly spending. Not what you think it is, what it actually is. Check your bank statements from the last 3 months and average it out. Number two, multiply that monthly number by 12, then divide by 0.04. That's your crossover number, your target portfolio. Number three, figure out the gap between where you are now and that number, then run a compound interest calculation to see how many years it takes at your current savings rate. There are free calculators everywhere online. Just search compound interest calculator, plug in your current balance, your monthly contribution, and 7% average return. When you see that number of years for the first time, something shifts. It stops being this vague feeling of being behind and becomes a concrete distance you can measure. And distances you can measure are distances you can close. Maybe it's 28 years away at your current pace. Fine. Now you can ask the real question, which is, what would it take to make it 22 years instead? Or 18? And suddenly you're not wondering if the math works for you. You're negotiating with the math. That's a completely different emotional position. I want to be honest about uncertainty here too. 7% average returns aren't guaranteed. Markets crash. 2008 happened. 2022 happened. There will be years where your portfolio drops 20 or 30%, and the crossover point feels like it jumped further away. That's normal. Historically, the market has recovered every single time, but past performance doesn't guarantee future results, and anyone who tells you otherwise is selling something. So here's the framework. If returns average 7%, you hit your crossover point at the timeline you calculated. If returns are lower, say 5%, it takes longer, but it still works because compound growth is relentless even at lower rates. And if something catastrophic and unprecedented happens to the entire global economy, well, everyone's plan is disrupted, not just yours. You hedge against that by building skills, maintaining your health, and keeping your expenses flexible. That's not doom talk. That's just being a grown-up about risk. The thing about the crossover point that really sticks with me isn't the math itself, it's what it represents. Every dollar you invest is a tiny soldier working a 24-hour shift for the rest of your life. It never calls in sick, it never takes a vacation, and it recruits more soldiers over time through compounding. When you're 36 and you invest $1, that dollar has roughly 29 years to compound before a traditional retirement age. At 7%, that single dollar becomes roughly $7.60. So every dollar you invest today is doing nearly 8 times its own work over your career. That's not motivational fluff. That's arithmetic. You're watching this at 10:30 at night. Your kid's asleep. The house is quiet. And some part of your brain has been running a background process all day telling you that you're behind, that the math doesn't work, that you started too late. I want you to replace that story with a number, your crossover number. Calculate it tonight. Write it down. And then realize that every single financial decision you make from this point forward either moves you closer to that number or further from it. That clarity is worth more than any stock pick, any guru's course, or any viral money hack. One number, 2 directions, earn more or need less. Both work, both compound. That's the crossover point, and now you know exactly how far away yours is.